After the credit markets gapped out in 2009, there was a lot of antagonism between the buy side and the sell side around how the credit markets should function and operate, and how liquidity risk and market risk should be managed when credit markets do gap out. And they're gapping out again. They're going to gap out again with the end of QE, and we're going to see tapering. So with me to talk about this today is Paul Reynolds, CEO of Bondcube. Paul, thanks a lot for coming in today.
Thank you.
You've weathered a few credit wars. What happened in 2009, and why is 2013 going to be even worse?
Well, I think in 2009, everyone really had the same problem, and that was that they had too much inventory, too much risk. They all wanted to head for the exit at the same time. The banks probably had an advantage in that they could get to more markets and more liquidity than the buy side. So the buy side were at a disadvantage. The banks didn't exactly win the war, but they probably came out less damaged than the buy side. Then we had the advent of the agency broker market that came in and offered an alternative to banking liquidity.
Right, so agency broker business really proliferated in 2009. Do you think that's going to happen again in 2013 or 14? I
think there's an opportunity for agency brokers to have a very good 2013, 2014, yes, I do.
But in the instance where in 2009 dealers were risk on and the buy side were risk on, as you said, everyone went for the same exit at the same time. Now we see the buy side holds the bulk of liquidity and the sell side has become more efficient about managing their balance sheet risk. Where and how are the buy side going to distribute their liquidity if they want to lower their market risk position as the credit markets change?
Their choices are the same as 2009 really. They've got the banks. You know, there doesn't appear to be an alternative means of laying off risk to adjust their portfolios to the new climate of tapering.
So we will see then just a shifting of the buy-side liquidity back to dealer books via agency businesses in the next couple of years. Is that the way this is going to play out?
I think as it stands, that is it. The banks and the agency brokers will look at this probably more as an opportunity rather than a crisis. Last time it was a crisis for them. This time I think the banks are much better prepared, know what the lay of the landscape is. It's the buy side who will get the surprise of how poor liquidity can be when everyone is heading for the exit.
Interesting. So there's a lot of talk though from the dealer community saying we don't have the balance sheet to reabsorb this risk, and you know, maybe there have to be some alternative solutions. Now we've seen a bunch of hedge funds, for example, that have come up on the wings. They've hired a lot of former credit proprietary traders. Will they reabsorb some of this risk? Are we looking at a more diverse range of risk takers? Are the agents going to facilitate that liquidity shift? How do you, what's the story with the banks and what they're saying about their ability to reabsorb risk?
So I think what the banks will try and do is go much more in the direction of agency broking. You know, that is where they see a match between what they want to do with their balance sheet, how they want to make their money, how they want to stay in touch with their clients, how they want to interact with their clients. It's important to maintain those relationships for the longer term.
Right.
In the shorter term, what can they offer? More than likely agency broking.
Right, so so trading in the types of bonds that they think they can sell on again quickly, or doing riskless principal matching and stuff like that. Now, you have a solution that facilitates that process and facilitates for matching of bonds in a less balance sheet intensive way. Why don't you tell us about it?
Okay, so what Bondcube is trying to do is it's trying to look at liquidity as a whole. So that's not just sell side liquidity, it's buy side liquidity as well. And in the event of a move to the exit, if that's what we're going to call it, then buy side liquidity will increase dramatically. If it's not possible to see that buy side liquidity, then there will be an asymmetric situation. You will have an imbalance of supply over demand because the banks will not be able to increase their balance sheets in this environment, and the buy side will be asking for that increase. So how do you cope with that imbalance? And what Bondcube does is it looks at liquidity as a whole. It lets everyone connect with each other. So for instance, the hedge funds, they will have the opportunity to see if they can match supply instead of everything having to go through the banks at the point of trying to find liquidity. So when someone is looking for liquidity in Bondcube, you put in an inquiry, you find a match darkly, so you don't get your market risk. You negotiate, you trade. That trade may cross through a bank, so the banks stay in touch with the trade, they get some revenue from the cross. Everyone is talking to each other in the same way. It's just without the market risk.
And how do potential buy-side liquidity makers make prices without showing their hand to other buy-side firms? Is there the risk of information leakage, or how does that become minimized?
So to prevent information leakage, all matches are dark. So the system will ask everyone within Bondcube who wants to be the other side of this trade. If there's a match, that's who you're negotiating with. That person knows about you, you know about them, no one else knows what you're doing, but they have all been asked. And it's not about price matching. The match is based on, are you the other side of the trade from me? And does my size match your size?
And so what
the price is a consequent negotiation.
And what is the kind of size orders that you think you're going to be able to target with this?
Well, I think what we've learnt recently is that for smaller orders, let's say in corporate bonds up to 1 or 2 million, this problem doesn't seem to arise. Market risk doesn't seem to be so much of an issue. That part of the market has grown dramatically in size. That's where the sort of healthy, functioning part of the market is. The part that is no longer like that is the larger sized order. So that's what we're aiming at. Not high number of trades, but a smaller number of trades with very large volumes.
Interesting. So would you describe yourself as like an electronic alternative to the agency business?
Yeah, I think that is a good explanation, yeah, a good description.
Interesting. Okay, well thanks a lot, Paul, for coming in to join us today. My name's Will Rhode, I'm the Director of Fixed Income Research, and joining me to talk about the gap in credit markets is Paul Reynolds, CEO of Bondcube.